Okay, so we will get started. So thank you for joining today's webinar. Appreciate the time that you've taken out to come and hear me out. I'm hoping that you would learn something of value from here and you would be able to take it away and implement it in your investing journey. A couple of more participants are joining, so I will give them a minute to settle in. Guys, we were just starting off with the webinar. I'm sharing my screen and you should be able to see mortgage refinance as one of the headings on the slide. So just to set some ground rules here or housekeeping items, I will start, I'll keep the conference lines muted for most participants. So I would just request that you unmute your lines if you're not speaking so that there is no disturbance. But I will keep the lines unmuted, and if you have any questions, feel free to unmute yourself and ask that question at any point in time during the webinar. You can also chat or put in your questions into the chat section, and I will read or review those occasionally and address questions if any posted over there. And also, if you feel that there are some concepts which are not clear to you as you go through this, feel free to interrupt me so that I can spend some more time on that and explain it to you. Okay, so let's quickly start with a good review of the agenda items for today. So we're going to talk about basically, in general, the opportunity space or what real estate provides in terms of investment opportunities. Some of the general strategies that people use or investors use to make their investments in the space. We'll talk about some of the challenges, and we'll try to address one of the biggest challenges that investors would face, if not at the get-go, but at some point on their journey, which is about capital. One of the solutions for that could be refinance or an equity take-out option. So we'll discuss about that in detail. I'll go over the advantages and disadvantages of that approach, some of the constraints that it poses. And lastly, I think to just make things a bit more real, apart from just concepts, what I would do is talk about a case study that I did for the Toronto real estate market, and specifically about the detached properties, single home properties within the city of Toronto. So we'll review what has happened in the past, and we will try to make a projection for the future, and then we and I, or separately, can make a determination as to do we see an opportunity to make money by sort of implementing the sort of approach that I'm going to lay out. Okay, so that is pretty much the agenda for the day. Any questions before we kick off? Okay. So let me give a disclaimer again before we get into the details that this webinar is provided only for general information purposes. You should not act purely based on the information or the material shared during this webinar, and you should always consult a professional before taking a step in your specific situation. Okay. And for those who don't know about me, my name is Neil Joseph. I'm a mortgage agent with the Windrose Group. I am licensed to operate in the province of Ontario. And my personal mission is basically to increase the knowledge of my current and prospective customers or clients about mortgage financing in general and help them make educated decision in their personal context. I am also a real estate investor, small-time investor rather, and I'm practicing what I'm going to talk about today. So I am following that journey, and hopefully you would also find value in that. So with that background, let me just show you as to what I like specifically about real estate and what it offers. Okay. So real estate is obviously an amazing opportunity space, and it has something for everybody. Right? But this is specifically what I like about real estate. You might have different sort of likes and dislikes about it. Okay, but okay, just to review these. So the first and foremost thing is housing is a basic need. Everybody needs a roof over their head, and there are very few things which sort of gets more basic than this. Right? You would probably have air, water, food, and clothing, and then you obviously need a roof over your head. So if you are addressing the demand which is out there for housing appropriately in terms of the value that you provide and the pricing that you offer, there is always going to be a demand, right? So it's a product for which always there is a customer base, which is which unfortunately is not the case with a lot of other businesses out there, but real estate does offer that. So that is primary. The second is debt investments and mortgages specifically get preferential tax treatments than what you would do with an equity investment, right? And this is one of the reasons why all rich people like debt instruments. If you haven't read the book Rich Dad Poor Dad by Robert Kiyosaki, I would highly recommend that you have a read. You will get some good insights in this aspect. Again, the interest cost or debt assumed to generate income is tax deductible. Plus, you can own properties under a corporate structure, which will obviously give you some benefits from a tax planning as well as estate planning standpoint. So again, this is one aspect that you should always investigate. Talk to your investor-friendly accountant and make sure that you go, get ahead on a sound footing, right? Something that you can build on, so that you don't have to revisit how you are approaching real estate later when you have sizable properties. So that's tax. The third is leverage, and this is what I love the most about real estate. I'm sure all of you on this webinar have other financial instruments, right? Financial investments. How many of you over here invest in maybe equities or ETFs or mutual funds? Feel free to maybe give a response in the chat section or just unmute and speak. Well, if not, okay, so I think a couple of people over here have investments. So again, so if you are to make an investment in such an instrument, be it mutual fund, ETF, or a stock of any company or equity of any company, how much money do you think you have to put in before you own that particular unit? Is it anything less than 100%? I don't think that is the case, right? You obviously need to put in all the money before you get that share. But think similarly from a real estate standpoint. How much money do you think you need to invest to own real estate? And I'm not talking from a absolute standpoint in terms of dollar to dollar comparison. I'm talking more in terms of how much money do you need to put in as a proportion of the entire cost to be able to own it, right? So real estate is one asset wherein you get a lot of leverage. And if you're talking from a rental property standpoint, it is like 4:1 because you can get a property in your name by just putting in 20% of equity or down payment, right? So that gives you a lot of leverage, and this is one of the key factors which you should look to leverage or utilize, so that you can grow your investments faster. And I'll give you a bit more example as to how that would operate, right? Then you have the passive aspect of the real estate returns, right? So the returns that you get from real estate is obviously on multiple fronts. You have the periodic cash flow, which it could be in the form of rent that you get monthly from your tenant. Then you have value appreciation, which is a rise in the market value of the property. And the biggest benefit is somebody else is paying for your mortgage, isn't it? The tenant who is residing in that investment property is paying off your mortgage. And at the minimum, you can expect to sort of beat inflation. So anything more than 2%, I think you can reasonably expect from your investment. And I don't know about you, but with real interest rates where they are, and my expectation is that it will probably go negative in the coming years, you can only expect assets such as real estate to increase in value. I don't know about what you think, but do you have an opinion in terms of when do you think Bank of Canada is going to raise interest rates anytime soon?
I don't think anytime soon they're doing that, Neil. At least not for 2-3 years.
Yes, which means that your asset prices are going to keep on increasing, because as interest rates reduces, it sort of gives more buying power to people, right? And that is exactly what you're seeing around you. Even when we are going through this sort of troubled times, do you see property prices reducing? At least not yet, right? So that's one of the factors, because interest rates are low and they're falling day by day. It sort of helps increase the value of these assets. Now, all of these sort of together combine to give you some sort of an opportunity to create multi-generational wealth, and I will explain as to what that could look like. Right. The trick is that you have to keep your approach very boring and simple. Right. Don't overcomplicate it. Keep it boring and disciplined, and you'll be able to sort of get the benefits out of it. Now, you might ask a question at this point as to, Neil, you're telling me all of these things, but have you created your generational wealth? And the answer is no, not yet. I am on the journey, and the reason I'm not yet there is because it takes a long time. And I'll again demonstrate as to what that could look like. Okay, so this is not really a get rich quick scheme. You won't make millions overnight. Okay. Now, so these were some of the things that I like about real estate. Now let's review quickly some of the common strategies that people use, right? When wanting to invest or utilize real estate as an investment vehicle. Do you recognize any of these terms on the screen?
Yeah, I recognize most of them. I can't remember what that BRR is. It buy, reno?
Yes, exactly. So it's
what that one is.
Yeah, it is called BRRRR strategy, and it stands for buy. That's the first. That's a B. Then the first R stands for renovate. So you renovate the property and rent it out at the value that you would get based on the renovations you just executed. Then you would refinance that property because after renovation you're expecting that the property value has increased. And then the last R is basically you repeat the process over and over again across multiple properties. So that is BRRRR strategy. Okay. The second you have is hold and buy and hold, which is your traditional approach in terms of how you buy and hold properties for years and years on until you're probably paid it off and then keep it longer. Rent to own is a strategy wherein an investor buys a property, but with the intention to offload it or sell it to the tenant who is renting that particular investment property at the end of maybe 2 or 3 years or at a predetermined point. The benefit to the investor is that he or she would have a sort of predetermined price at which they would exit the property. So it gives them a surety in terms of what they would get as an exit. Now, it could go with them or no, against them based on where the actual market prices tend to be at the end of that period, but at least it gives them the surety as to what their exit price is. Flip is more of an income generating strategy wherein people get ownership of a property for the short time, renovate it maybe, and sell it at a higher value. Assignment is typically what people use with respect to pre-built condos, wherein they book a condo and maybe before even getting closing on the mortgage, they will sell it to other investors or other people who are wanting to buy that property. It also works in terms of other assets as well. It could be a short-term assignment asset wherein an investor goes, looks at a property, probably buys it at a cheaper price than market value, and then tries to immediately sell a buyer to whom the contract is flipped over, right? So these are some of the income generating aspects. Wholesaling again is associated or similar to assignment. It can get confusing in between. Multifamily is obviously a property type wherein you're investing in a property which has a multiple number of tenants in it or could accommodate a lot of tenants in it. Usually it is 5 or more units within a property you classify it as multifamily. And private mortgages is the your own banker approach, wherein you become the lender or the investor becomes a lender and they lend money out for other investors or other buyers to get to buy property, right? So it could be a first mortgage, second mortgage, and whatnot. So these are some of the common strategies that people use. And again, it's not just limited to these. I've just called out a few because there isn't enough real estate space on this slide to depict everything, right? Okay. Any questions about some of these strategies that we talked about? Okay. Now.
Yeah, actually, I have a question on the multifamily. What class does? How many units is classed as residential over commercial?
So the commercial is where you would have more than 4. It usually gets classified as commercial, but again, it also depends on how much of what do you call, if you have shops or retail space along with your property. If it sort of crosses a certain threshold, then other properties also could be deemed as commercial. But the usual benchmark is 5 and more. Okay. Okay, so let's go ahead, and now I'm not sure if any of you have sort of thought about any of these strategies or any other strategy in mind in terms of investing in real estate, but what do you think is the common challenge that you've encountered? Or maybe it's more than one.
Yeah, it's money, right? Raising the money for down payments is a problem, and getting approved by the banks or brokers is another problem, right? Because it'll go on your debt ratio of yourself, right? If it's residential, and then if you go commercial, you're talking about a lot more money.
Yes.
That was just a couple of problems I can see.
So, sure, the capital is one. Any other challenges that you see? Okay, some of the things that I can at least think about is maybe people are not aware, or the investor is not aware of a certain strategy, doesn't have the confidence to execute it. Some people might deem any of these strategies to be too risky for their risk appetite, and hence they don't want to do it. Or something like a flip takes its own time, right? There's a certain time commitment that you need to put into that strategy, and you may not have that time. So that is a challenge that you have in executing that kind of strategy. So these are some of the common challenges that people have. Now, there is obviously solutions for each of these challenges. It could be training, it could be mentoring, or it could be doing a joint venture with somebody else who has the time and you have the money to do a flip. So all of these could be worked out. But what you will try and address is the question about capital and how you could address that based on what you should commonly have within your property, which is equity, right? Now, the capital for any of your investments can again come from different sources. It could be savings that you have out of your income, or what you save on a month-to-month basis. It could be capital gains that you could have from selling any of the other assets. It could be another real estate property. It could be by selling your financial instruments like equity, stocks, mutual fund, ETFs, REITs, whatnot, right? Or it could be other non-financial assets as well. Another option could be that you could borrow on a line of credit for your down payment on your credit card. If the amount is not so big, you could borrow from your friends and family if they are willing to do so. And of course, the lenders of different kinds are available. Your A lenders, the B lenders, the private lenders, from which you can, in some form or fashion, you can borrow that down payment. And of course, the another source that you would have is the equity from your investment properties or even inheritance. So these are some of the avenues that you have in terms of getting your equity. And we will talk, again, narrow it down further and talk primarily about getting the equity out of your investment properties. One of the common solutions is obviously mortgage refinance, but there are a few other instruments as well that you can have access to, depending on what the situation is. It could be a home equity line of credit, it could be a second mortgage, or you can even pledge another property and get money out using a promissory loan or hard money loan. So the options are a lot. Now, the reason I like mortgage refinance is because it is one of the cheapest options of the others which I just mentioned about. And again, it is sort of a long-term solution, while the others tend to be a short-term sort of a bridge solution before you eventually have to sort of do a mortgage refinance to keep the sort of to make it more efficient, to put it in a better way, right? So mortgage refinance is one of the options. Now, one of the key aspects is that obviously this is a long-term approach, so you should discuss with some other professional, be it a mortgage broker, to figure out as to when do you think this is an appropriate strategy for you. Again, it changes based on what your current or your specific situation is. Right now, in case you are not really aware as to what mortgage refinance is, I'll just sort of give you an example and to give you a better understanding of it, right? So Let's assume a scenario wherein you have purchased a property for say $500,000, so $500,000. You obviously, since it being a rental or investment property, you have put in a 20% down payment, which in this example works out to be 100,000. So that becomes your initial equity. Now, suppose as time passes and over 2 years, the price of that property has increased by 75,000. So the price becomes 575,000. And as you were also making your mortgage payments over that 2-year period, maybe the principal down payment or principal outstanding or the mortgage outstanding has been paid down by 40,000. Just an example. So that would mean that your outstanding mortgage after all of this would be around 360,000, right? So 400,000 minus the 40,000 that you paid off. So the new outstanding becomes 360. Now, as per the regulations, you can refinance that particular property up to 80% of its new value or the reassessed value, which in this example works out to be 575. So 80% of 575 would be 460,000, right? So the difference that you now see between 80% of the new value and the mortgage outstanding 360 is something that you can extract out using a refinance. So essentially you replace the existing mortgage, you refinance that particular property and get that 100,000 out. So your original liability, which was 360,000, is replaced with a new liability of 460,000, but you can get the difference out, which is 100,000, and you could use it for any other purpose, right? So this is how a mortgage refinance, typically an equity takeout, works out. Is this concept sort of clear with all of you?
One question, Neil. So who decides it increased by exactly 75,000 or 76,000? I mean, who gives you that?
Great question. Again, valuation is a very, you could say it's not an exact science. So there is no one person who would arrive at the same value for the same property, right? And that is why we have buyers and sellers. Now, typically what happens in such a scenario is you have somebody called as appraisers. These are sort of designated licensed people, professionals who are engaged by the lender. There are approved appraisers with each of the lenders, and whenever we approach a lender with whom we want to refinance a property, they would have or ask us to engage as appraiser, and they would go ahead, do a study on that property and arrive at evaluation. Now, typically there are different methods in terms of how evaluation is arrived at. You could do a sort of a cost plus approach, or you could do something like a comparable study analysis, right? Wherein, okay, if 5 or 6 other properties of the similar kind have been sold in the vicinity of this property, right? The property that you have, then they would determine based on that the recent sale purchase. So that is how typically prices are determined, or the new valuation is determined for a property. Does that answer?
Yep, thanks.
Let me just check if somebody is waiting.
I was going to ask Neil, do you think, like I understand the refinancing of your mortgage, but do you think that's always the best thing to do? Because you can have those, I know on one of my properties I have a readvanceable mortgage, so I have a line of credit.
That's right.
So I just take it, so it actually frees up more money for me if I want to buy a couple of properties and get someone else to advance rather than, and I'm only paying what I use, right?
Yes, that's right. So yeah, typically you would have these multi-line products, and STEP from Scotiabank is a great product of that sort. Yes, you can definitely finance your down payments out of that, but I'm not sure if you noticed, but the interest rate which you are charged for on the line of credit is always a bit higher.
Yeah, that's correct.
Yes,
correct.
So you could do that, sort of take the money out, because you obviously want access to cash without having to wait for the refinance to go through, right? So you could obviously do it in a short term wherein you pull money out of your line of credit and buy the property that you want to, but eventually the refinance sort of opens up more room for you. It sort of improves your cash flow. And that's the reason that in the longer term, you should try and do a refinance, because one of the benefits with refinance is that you can extend your repayment period. Again, we'll talk about it in one of the slides here, is that you could extend the repayment period to 30 years, right? Which, if you look at from a line of credit standpoint, the longest that you can extend, or what lenders would consider as repayment period on a line of credit, is 25 years. Does that answer?
Yeah, it does. I know. I just find that if money's a bit tight and you're trying to do more than one thing, there's advantages and disadvantages to both, right? I mean, the line of credit, you just pay your interest back if things are tight, and you can pay it off with no penalty as well, right? You have extra cash flow.
Absolutely. I'm not saying that it is not a good option, right? That's a more what do you call, tactical approach, wherein you have access to cash, you just pay the interest. But what happens is, if you keep that longer, is you suppose you want to buy another property and you have a line of credit, you have a first mortgage. The way that lenders look at the repayment liabilities associated with all of these instruments are different.
Okay. Yeah.
And that is where.
I'm just looking.
Yeah.
Yeah, just different options, right? There's advantages and disadvantages to that.
Absolutely, yes, of course.
Yeah.
So, as I said, some of the advantages, and again, the left side is the advantages under the white background. The black background has the disadvantages. So, essentially, you can improve your cash flow by keeping payments lower after you've executed a refinance. You can, again, as part of that, you would extend the amortization period, and generally, you would keep it maxed out at 30 years. Okay, and this helps to, in fact, improve your return on equity, because you would have very less cash invested in that property, and your equity might probably be what you have been sort of increasing over a period of time by either the increase in the valuation of the property, or it could be the principal repayments that you're making as part of each mortgage payment. Again, as I say, when I say you, meaning your tenant is paying down your mortgage, right? So, one of the other benefits with refinance on rental properties, of course, the interest that you pay is tax deductible. So is the case when you have a line of credit or a second mortgage on a principal property, right? Because you have that as distinction as to where that money was used for, and you can get tax reduction on those interest payments. And again, the last point is cheaper access to equity than HELOC or second mortgage. Again, that is a long-term view. Strategically speaking, I would not even worry too much about the difference in terms of the interest, the interest cost that you have. I'm more concerned with respect to improving the cash flow. So that's on the advantages side. Disadvantage, of course, is, again, it's a counterpoint, which is extended amortization period, something that you just keep in mind. You have not paid off that property, you would never want to pay off that property and want to have a mortgage pending on it always. There is obviously legal costs associated with each refinance, so lawyers are involved, you have to do the paperwork, so there is some legal cost which each refinance that you do. With the step product or the similar multi-line approach that you mentioned some time back, that is always a re-advanceable, so no lawyers are involved, so that doesn't have legal cost. And other aspect is there is no tax advantage when you do a refinance on your principal residence and use it for investment properties, so you would not use this approach there. And again, one of the other bigger aspect is, if you happen to have, of course, prepayment penalties applicable for all closed mortgages, be it variable or fixed rate mortgages. The penalty just happens to be higher if you have a fixed rate mortgage and if you want to refinance it. So that's a disadvantage. Again, I'm going to share a link with you, all of you, on the chat. This is a site to this is linked to a site which sort of gives you some information about how taxes are calculated or what kind of tax benefits or how tax is treated in tax in rental income or rental properties are treated from a tax standpoint. Okay. And then we have some of these constraints associated with the refinance, which is You cannot take out more, or you have to leave 20% equity in the property after you do a equity takeout using a refinance. Right? So the maximum that you can take out is 80%. The timing at which you could do the refinance is obviously dependent on you being left over with 20%. So that happens based on the increase in property value or the repayment of the principal outstanding on the mortgage. You can only sort of have an amortizing period up to 30 years with most lenders. There is just one lender which gives up to 35 years. So that's the limit, right? Again, this is in the A space. If you go to B lenders, some of them have a longer amortization period. Now, one other constraint with this approach is, even if you have more equity, you may not want to take the entire 80% or refinance up to 80% loan to value if the rent that you're getting on these properties is not keeping up with market rate, right? So if you have a long-term tenant, then your rent is going to be lower, and the cash flow may not be very efficient if you take the entire equity out. So that could be one constraint as to why you may not want to do a refinance up to your available limit, even if you have equity. And one of the last other points is, the constraint is, lenders have their own limits in terms of how many mortgages they would give to a specific investor. Banks are not very enthused about working with a lot of investors, so they limit the number of properties or mortgages that they will lend on, and hence we need to be sort of cognizant about which lenders are we approaching at what stage of our sort of growth. And again, lenders treat rental income out of investment properties differently. No lender looks at it in the same way. They have their own calculation in terms of how much of benefit they give, the rental income, depending on which lender they are, right? So this is where you should work with a mortgage broker to figure out what your best options are. Okay, I think we have talked a lot in terms of the theoretical aspects of it, and I just want to maybe switch into the case study. But before I do so, any questions that you have which need to be addressed before we go ahead?
I just have one more, me again. Typically, how many mortgages will a bank lend you, or is it dependent on your own? Like, is it like 4 or 5, or?
Yeah, typically that is a number, 4 or 5 for a bank.
Yeah. Okay, thanks.
Yeah. So let's talk about a case study, a study that I did for on my local market, which is Toronto. So what I was looking at is, studying the price movements which have happened over the past decade. And I wanted to see as to how you could efficiently take money out as the property prices increased over a period of time, right? So my approach was basically mimicking a sort of a BRRRR approach, wherein I would take equity out of an existing property. I would, in the model, buy a new property, rent it out, refinance when the equity levels are at a certain level, and repeat the process. Okay, so that was a theoretical approach taken for this study. The specific property type that I considered was, again, the detached homes within Toronto, and I have used the average price, which is published by one of the listing the realtor sites within Toronto, and I use that for this analysis. The time duration that I've considered is data which is available from January of 2010, and the assumptions that I incorporated for this modeling is, I've assumed that the rent covers 100% of the expenses. That means the rent covers the mortgage, the property taxes, any other expenses that you have with your rental property, right? So I assumed cash neutral position. This may or may not be true depending on what rents you're getting. Second assumption is, obviously you have been able to successfully get a mortgage on that particular property. And the third is, I've assumed closing costs to be at 3% for each transaction. This number sort of varies. It could be 1.5, it could be 4%, depending on the property and the situation. But I've assumed for this analysis, 3%. Constraints obviously have been that the entire down payment, which is the minimum down payment required, is 20%, and the closing cost is taken out of an equity from a property that is already in my portfolio, or in the portfolio, the theoretical portfolio. And the other constraint that I impose is I would leave not 20%, but 25% of equity in the property after a refinance. So 5% just to give me some cushion so that I'm not at the border, right, with any of these transactions. So this is how I sort of model the study. And I was basically inspired by another broker who was talking about his experience, wherein he or she was able to buy 12 properties or 12 condos over the period of 10 years. So I just wanted to see as to how that process sort of works out, right? So I did this analysis, and what I found is that the average average price of a detached property in Toronto was 484,000 in January of 2010. The average price today is 1.23 million. So it's approximately 2.5 times of appreciation, right? In terms of normalized growth, it is about 1% a month. So that means property prices are increasing about a little under 1% each month. And over a period, it is normalized to 9.31% over the period of 10 years in the past, okay? Now, I think I gave you the, the answer, okay. Now, so if we follow the strategy that I sort of mentioned before, right, which in I'm pulling out equity, which is 20% and the closing cost of 3% out of my existing property, the first property that I bought, and I keep repeating that process every time there is sufficient equity in my property, and just leave 25% remaining in each of these properties. Can you guess as to the number of properties that you could have got, right? 12 is not the number that I got a different number because I started in January of 2010. Do you have any guesstimate? Again, the investment is purely limited to the down payment that I make on my first property. And then on all down payments are coming from my investment properties. No guesses? Okay. So the number that I got was that you could buy 6 more properties out of the first investment that you made. So in total, you would have 7 as of this month. Does it sound exciting? Or you had more expectations?
So, assuming all 6 are rented out and paid for by their rents.
That is right.
Like a neutral cash flow.
Yeah, you're not getting penny out of it. Whatever is coming is just satisfying whatever liabilities that you have.
Interesting.
Right. Now, do you think this could be a way to create a lot of wealth if you just keep doing that over a period of time? I'm sure there are some assumptions built into the study, but if not 6, maybe it is 4 or 5, right? It cannot be too far away. Okay, so now obviously this is in the past, right? The ship has sailed, water is under the bridge. We cannot do anything about it if you have not invested in the property in 2010. Okay, but and I don't know for sure as to what the future holds, but maybe the numbers could be something like this, right? This is what somebody who invested in 2010 would have sort of benefited off in terms of just pure numbers. So they would have had made a down payment of about 96,400, and their equity based on the price increase in price and the down and the top mortgage payments would have increased to 2.2 million approximately. That's a theoretical study. So it's a growth of close to 19 times, right? 19,907% growth in equity. You obviously have a big outstanding mortgage of 6 billion approximately. But again, it is not too bad when you compare it against the equity that you have. Now, compare it against another strategy, which is if it was a purely buy and hold approach. As I said, this was the value of the property, average value of the property in 2010, and this is what the value in 2020 of this month. So and you would probably have not paid off the entire mortgage. So your equity would have been lesser than 1.2 million. But by following the other approach of pulling out equity and keep on investing, you could have increased it to 2.2 million. So roughly close to double, right, of what you could have if you just held on to that one property. Now, do these numbers sort of scare you?
Yeah.
But I'll tell you another aspect of it. In fact, it is even a lesser risky approach than if you just held on to one property. And I have a worksheet which sort of tells you. But before we do that, I just want to make sure. I just want to have a discussion about what do you think could happen in future, right? Because that is what we are more concerned about, as to how we could benefit from such an approach if we are to start today, right? So for that, let's make some assumptions, right? Now, when I presented the earlier case of the first 10 years, I mentioned that the month-on-month growth was a little under 1%, so 0.98 is what I found. And the normalized year-on-year growth was 9.31%. Now, can we assume this is a more reasonable number for the future? 0.3% month-on-month, which is lesser than 1/3 of the current trend that we're seeing, and which would give probably an annual increase of 3.72%. Okay, it is not too far away from the desired inflation rate that we have in this country, and it is. I believe it is I personally believe that it is sustainable unless we have a big catastrophe, right? If something like COVID-19 happens and the entire world stops, then maybe yeah, not. But again, even in this situation, we are seeing something else. So this is the figures that I think is conservatively possible. And if we follow that approach, again, give it sufficient amount of time, this is what you would see in terms of average property value. So we are at 1.23% or 1.23 million as of today in terms of average property. And that would have gone up to 2.55 million in 20 years. That is at the end of 2040. Do you think it is realistic? Is it atrocious?
Yeah, possible.
It's possible, right? Okay. Now, so what do you think would be the number of properties that you could have, and what would that journey look like if you had to follow the same approach of leaving 25% down in or equity remaining in your property and take out whenever you have 20% and 3% for your closing. So whenever you have essentially 48% equity in your property, you take it out. You take out 20%. Do you want to guess a number for the next 20 years? No, nobody's brave enough.
3.
This is what the picture would look like. So, just to explain this is the first property that you would buy with a down payment, right? Of I have the figure in my next slide. So this is the first investment that you would do, and then you would let it sit. So assuming the growth figures that we assumed before, and the mortgage payment, and for the mortgage I've assumed 3% as the rate of interest, and a 25-year repayment period. Okay, assuming that as my interest rate and the principal repayments that I'm doing, by 2026, that one property will give you enough equity to buy a second one, a third one by 2031, a fourth one by 2036. But before that, the second home will have enough equity to give you another house in 2032. And the third house will give you another property in 2037. And so on and so forth, it goes on. What have you invested? Over here. That's it. And you just keep pulling equity out from then on. Would you be happy with this?
Definitely.
Okay. Now let me just share some numbers, right? So this is, yeah. So this is the down payment and the closing that you invested in your first property, right? That in 20 years would increase to 7.7 million, assuming the numbers that we assume. Okay, so this would be a growth of 30 times, approximately nearly 31 times in equity over 20 years. Give me any other investment sort of instrument which gives you that. Obviously you will have a huge outstanding mortgage of 12 million, but it is not so bad if you look at the equity that you have, right? It's 7.7 million and you have a mortgage of 12 million. And I will again show you what the ratios are in the sheet. Again, so just to sort of revisit, this is the bottom. On the bottom is what you see as the average property value. So average property value increases from 1.23 to 2.55. While this is the amount of property that you control. So starting with one property at 1.23 million, you would own property worth 20.43 million. Compare that to just keeping one. Right? So I think a couple of key takeaways are, don't let your equity sit idle. Think like an investor and not like a homeowner. And again, I'm going to sort of revisit this aspect in the sheet we review. You should think about cash flow, meaning keeping your cash flows neutral to positive and having access to cash, right? So don't worry about just working with A lenders. You can use B lenders, private lenders, and still make money. And I'll show you how. Don't get bogged down, again, the same point, right? Don't get bogged down by the higher cost of funds that you might see. So your your A lender might give you a loan at say 2%, 2.5% for a rental property. B lender might charge you close to 4%. So that's a difference of 1% in terms of cost, right? And I'll show you what difference it makes from return on equity standpoint in the sheet. Again, the last point again is you have to be savvy about the lender selection to make sure that you don't get capped. You have to sort of go with the tougher lenders to begin with, so that you have access to when you need it, you have access to the more lenient lenders later on. So I think this is pretty much from the presentation standpoint, and the next 10 minutes that we have to the schedule hour, I just want to share the worksheet that I was mentioning about. And all of you should have got this worksheet in your mailbox. At least I shared one of the versions that I had prepared, and it should be in your mailbox. And this is sort of where the numbers are coming out, right? Are you able to see my screen?
Yeah.
A spreadsheet?
Yeah.
Okay.
Yeah.
Okay, so the cells in yellow are the ones that you can modify. Okay, and I'll explain as to what each of these means. So the first cell is the year in which you'll make your first property purchase. So I'm assuming 2020, and the month is August, so 8th, the month number 8. So this is my input. This is the other cell wherein you can change. So I'm assuming 25% is the equity that I will retain in each property, and I not take more than that out. And this is the amount of equity that I'm going to take with each pull out. So 20% goes towards my down payment, and 3% is towards my closing cost. Okay, so these are numbers that you can change and play around with and see as to what you're comfortable with. And here, this cell is where I'm manipulating the monthly, month-on-month average growth in property prices that I am forecasting for the future, right? So we are looking 2020 and beyond. So this is the same numbers that you would find in the presentation. And at the bottom, the summary rows, these are the figures that you would see. So just to point out, right, the number that you should look at is the leverage projected. So leverage is nothing but the amount of mortgage outstanding that you have compared with the equity that you have in your properties. So you have a mortgage of 12 million and you have an equity of 7 million. So the ratio of that is 1.3. Bear in mind that you started with a ratio of 4 because you have just paid 20% of your property value, right? Or as down payment. So the leverage that you start off with is 4. And if you do not if you retain more than 25%, as the number sort of increases, right, this ratio decreases further, right? So you are not leveraging enough, and this is the leverage that you have at the end of 20 years, right? So you would have a leverage of only 6% compared to what you would have in terms of keeping it at 25%. So you are making your money work more by increasing this value. Okay? But notice another aspect which goes along with it. So if you look at the annual return on equity that you have, following this approach is about 18%, right? So the money that you have is not working, or whatever. If you put $100, it is giving a return of $18 every year. But if you increase your retained equity higher, then it falls down to 12%. So your money is giving you less returns on a year-to-year basis, right? So you have to find a right balance as to what is it that you want to keep. You want to keep 100%, you want to keep 25%, 20%, or somewhere in between, right? So that's the entire game. You have to get comfortable with what numbers you want. But if you go with 25%, then and a very conservative growth, then you could have in all 8 properties at the end of 20 years, or 7 properties which are spawned out of the first investment that you did. So this sheet is available with you. Feel free to play with it. And the price history is all in this last sheet. And the 30% that you use here is basically just brought into this cell, and then the projections are carried out. Now, as you go along, right? So we are in the month of August when you are expecting a 30% increase in property value. But as you progress along, when you have actual figures, you can obviously input into that and see as to whether you are keeping up with this approach or not. So this could essentially be a plan that you track to, right? If you're talking in terms of project management concepts. So this is something that you baseline, and then you see as to whether how you're progressing along that plan. So this is what I want to share with you. Any questions in terms of the case study that we sort of talked about? Does it sound outlandish?
It sounds good. I mean, 6 or 7, maybe not, but at least 2 or 3 is doable considering the extra cost that comes with the property, right? I mean, any maintenance, any repairs, and all those things. So considering that, maybe
Yes.
2 or 3 is still doable, right?
I am sure more than that is doable, but yeah, it's about finding your right balance, right? How much do you want to leverage, you want to stretch, versus how much of a comfort you want. Again, from a payment standpoint, right? The trick is to keep the mortgage payments low, because the intention is that you never pay these mortgages off, right? So you keep refinancing, you keep extending the tenure, because you're not getting hit from a interest rate standpoint, because you can claim everything back. And the principal payment is anyway coming from the tenant, so somebody else is paying your mortgage, essentially. But what the benefit that you get is, of course, the equity that you are growing within these properties that you own. And the more you have, the more growth you see.
Right.
How does everybody feel? Do you think this presentation was useful? Does it give you some new ideas?
Yes, it is useful.
Thank you. So what I would do is I will send you one more sheet. So the sheet that I shared with you over email is, or again, Stan, maybe you haven't got it. The one that I sent over email is for the condo properties within Toronto. There is one more sheet that I prepared which has data about the detached properties that we talked about in the presentation. So you will find that in your email shortly. And if I've been able to record this video, then I will send a link to this video recording as well. Any questions before we close?
No, I think this is good. Thanks, Neil. I mean, I thought only HELOC was a instrument, but this is another. So, yeah. eye-opener.
Yeah, I think the instruments themselves are very simple, right? So refinance is simple in itself. HELOC is simple in itself. It's the whole magic is about how you bring this together and how you incorporate it so that you have a system which grows your portfolio. On its own, these are very dumb instruments.
Right. Yeah. Now I know why the demand supply is so strange here, because people keep investing, and that's why and have made huge amount of properties, like you said, right? 7, 8, and all that. So yeah, it's
Yes.
interesting. I mean, we can also start on that journey.
Yeah, and it doesn't, as I said, it doesn't. It just takes your first investment, and slowly but steadily you can grow that.
Right.
I have a question actually about refinance, like about mortgages. So considering prepayment cost for fixed rate mortgages is very high, so
Yes.
you would, I'm assuming you would suggest to keep variable mortgages, right?
Yeah, that is my personal recommendation, that you should have variable mortgages, because one, obviously the prepayment, the penalty is very low, which is like 3 months. You know for sure what your penalty looks like at the moment, even without asking the lender, right?
Mm-hmm.
But with a fixed rate, you always get a shock.
That's what is happening actually with us right now. We're doing refinance to purchase another property, and our mortgage was fixed, and yeah, like it's quite a few $1,000s actually to get out from that mortgage. Yeah, that's for sure.
And I'm not sure when you checked with the lender, but if you check this week, it would be even higher, because as the rates go down, your penalty increases.
Yeah, that's exactly what's happening. Yeah.
So yeah, if you have those minds, and if the penalty is not too big, go ahead. But next time onwards, and again, especially for your investment properties, I think the way to go is variable rates.
Okay.
You would approach differently maybe for your principal residence, and the concept that we talk about, you will not apply it to your principal property. You don't want to take equity out again and again out of a principal. You would do that only for your investment properties, or at least that's a more risk-aware approach.
Okay, so you wouldn't suggest actually to do that with your principal one, right?
Yeah, if you are you just want to make your first investment for your investment property, then yeah, you could take equity out of your principal, but make sure that you don't do further, right? You just pay it off over a period of time then, or when your investment properties are big enough or the portfolio is big enough, maybe you can take equity out of that and pay off your principal. So that way, the roof over your head is assured.
Okay.
Okay. So again, I think we are about time here. So I just want to say there are some resources that I have. I publish content onto my YouTube, Facebook, or my website regularly. We blog posts which I post every week. So if you are interested in following me, these are some of the avenues that you can do so. And again, my primary job is as a mortgage agent. So if you are in the market to get a mortgage, or if you want any consultation, you can feel free to reach out to me. My number and the email is mentioned. Again, you will find the same in the email that you are going to receive as well. Any other questions before we close?
No,
Thank you, Neil.
Oh,
Awesome.
thank you.
Thank you for sparing your time. And again, have a great evening. Talk to you soon. I should soon have another interesting topic for you.
Okay, great. Thank you. Bye.
Thank you.
Thank you. Bye. Take care.
Thank you.